Hey, what's happening, guys? Dan Darrow here with another Options to Play video update. So, what I want to talk about in today's video is actually something that we spent some time going over in our most recent option session, right? So that's option collars, and while we did spend, definitely a few minutes going over it more in depth, right? Didn't really get into a real world example, right? We did a hypothetical example, and I just, as I was screening different charts, different setups, this deer pattern kind of came across my radar, and it was one that I felt was maybe like a good um, one to use as an example or like an illustration of kind of what an option collar would look like in the real world, and maybe some of like the benefits versus drawbacks of it, right? So this will be a hypothetical, um, but it's just something that lines up pretty well, and you'll kind of hopefully get a better idea of what I mean, or what like the utility of these option collars is a little bit more clearly. All right. So for those of you that weren't able to make the option session or just haven't listened to that recording, collars just very quickly are basically, think of them as almost like bearish risk reversals, right? So they are the combination of selling upside call position to finance the downside put position. And what's important with option collars is that there should be a long equity position accompanying it. Okay, so it's basically like opening a covered call, right? And then using the proceeds of the covered call to finance the purchase of a downside put position. And what the main benefit of this, or why people tend to like these types of ideas as hedge strategies, is that the cost of the hedge is typically lower than if you were just bought a put outright, right? Because you're using the proceeds of like the short call, so like the sale, to finance or maybe offset a portion of the proceed of the cost of the downside put, right? And again, this is when a company buys stock. Because if there was no stock, then it would be a bearish risk reversal, maybe a short risk reversal, and then the risk profile of that trade changes completely versus having like the long stock. All right, and some people while we were going through like the session and going through like the lesson, some people were wondering, what would be the benefit of doing that, and it's really a lot of times I find when people that are holding like long stock uh, get to the point where they're thinking of like a hedge, it's typically because A, volatility is a little bit higher in the market, or B, some sort of catalyst is coming up, right? Um, whether it's like, China trade tensions or the G20 or earnings in this case, which will be like in the middle of August on Deere, right? You're looking at the stock that's pushing up into what's been like a multi-year level of resistance, right? It's had like a crazy, crazy great move from the low back in May. And you're thinking, okay, like this thing has had a huge run. It's got all sorts of headwinds and it's bumping up into a long-term area of resistance, right? You're thinking, okay, hypothetically, you're along the stock. You're saying like, oh, well, there's probably not a whole lot of upside from here, and I'm worried that, if the trade tensions start to ratchet up again, or if earnings disappoint again, that there could be some material downside from here, right? So it seems like the risk reward is more skewed to the downside scenario, right? Like the stock that's failed many times up in this area has had a massive run and has some really heavy headwinds at play, right? So you go into the options, right? So hopefully this will help you see what I'm talking about a little bit better. So you go into the options and you see like, so going through August 16th, so that'll go through the earnings report. You're like, okay, like, I'm starting to get a little nervous. I feel like the stock could be due for a pullback, and I want to hedge through earnings, right? So you're looking, but you see that, to buy, the stock is currently trading like close to 167. So to buy the 165 strike put, it's going to cost you about $6, right? So the implied volatility is about 10 to 11 percentage points above historical, right? And you're gonna have to lay out about $6 for the hedge, so meaning that it's gonna have to drop below 159 for that hedge to really kick into the money, right? Start to recoup the losses one to one, right? And you might say, okay, for $166, $167 stock, it's not that significant. But when you look at it, that's basically like 6 points, 6 points or so is essentially like a third of the return for the year for Deere, right? So it's up like 18, 19 points year to date. So you're basically to hedge, you're basically paying like 33% or like one third of the year to date gains just to hedge. So it's a pretty significant when you look at it in that respect, right? So you can see why people might be a little bit more reluctant to lay out that type of money to hedge on the downside scenario, right? So what an option collar would mean, it would be basically looking at some sort of upside call. So let's say, like, hypothetically again, like the 170, right? If you could sell the 170 for 525, right? So again, this is like a company in like the long stock, right? So you sell it for 525, and you use the proceeds of that to pay for the put, right? So there's still going to be a net debit. So you're still going to have to like lay out some money, but it's the difference between 525 and 6. So say about 75 cents versus of having to lay out like 6 points, right? So that's one of like the main benefits, right? Is that like the cost of financing that put is going to be significantly less because you're selling this upside call to finance it, right? Now, what are the drawbacks? Well, obviously, if you're selling the call, then that means your upside is capped. So theoretically, if Deere has like a crazy good number, or there's some major update with the China trade relations and it breaks through the top of this range, well, the problem is that you sold the upside call and now your gains are basically capped above 170, correct? Because you sold that call to finance the downside put position. So above 170, which in this case would be about to be like a $3 like $3 window where the stock could rise up to 170, but then above 170 it's capped, right? So those are like the benefits, or the main benefit, and the drawback of the option collar, right? And I just like the way Deere has played out over the past month and how it's bumping up into like this big area of resistance with like multiple headwinds, a couple of catalysts coming up. It just felt like a really nice example to kind of like illustrate what I meant with, or why we spend time going over option collars, and why for those people that have equity and option strategies, or maybe they have some trading, or maybe they just use options as hedges. This is definitely one of those strategies that you want to like add to your playbook, or maybe start to look into a little bit more, because it is pretty useful in like certain scenarios. For those people that are a little bit more risk averse, right, or that want to maybe have a little bit more hedges in place, like this is like a different way to go about it. All right. So I know people had questions about the collars when we talked about it in the lesson last week, and I'm sure you probably have some questions. So if there's anything I can like go over a little bit more in depth, don't hesitate to reach out. I always love to hear from you guys. So if I can help, I'm glad to help. All right. So hope you guys have a fantastic night, and I'll talk to you all tomorrow.